Welcome to StockTok's deep dive into Axon Enterprise. Axon Enterprise is a global provider of cloud software and hardware solutions used by law enforcement, corrections, fire, and emergency services agencies. The company's core business centers on body cameras, cloud-based evidence management systems, and computer-aided dispatch software. It operates in the intersection of public sector technology and industrial software, a space characterized by high switching costs and recurring revenue. As of Monday, May 11th, the stock is trading at $388.53. Over the past 52 weeks, Axon Enterprise has traded between $339 on the low end and $885.92 on the high end, placing the current price roughly in the lower half of that range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Axon Enterprise generates revenue through two principal channels: hardware sales, including body cameras and in-car video systems, and software-as-a-service subscriptions for cloud-based evidence management, records management, and computer-aided dispatch solutions. The company's customers are government agencies, predominantly law enforcement and corrections departments in North America, but increasingly expanding into fire and emergency services. The competitive moat centers on switching costs and network effects. Once an agency adopts Axon's ecosystem, migrating to a competitor becomes operationally and financially burdensome because all evidence, records, and dispatch data are locked into Axon's cloud infrastructure. This creates both recurring revenue and pricing power. Our StockTok score for Axon Enterprise is 60 out of 100, rating the position as a hold. Breaking that down, valuation scores 10 out of 20, reflecting stretched multiples. Financial health scores 14 out of 20, signaling stability but not strength. Profitability scores 4 out of 20, indicating margin pressure. Growth scores 20 out of 20, demonstrating robust expansion. And smart money scores 12 out of 20, showing cautious institutional positioning. Now, valuation. The question every investor has to answer: are you paying the right price? Axon Enterprise trades at price-to-earnings multiple of 246.89 times trailing 12-month earnings. That is an exceptionally elevated valuation. For context, the broader industrial sector typically trades in the range of 18 to 25 times earnings. Even software-as-a-service peers, which command premium valuations, rarely exceed 50 times earnings. The forward price-to-earnings multiple, based on analyst consensus earnings estimates for the next 12 months, sits at 48.21 times. That represents a meaningful contraction from the current trailing multiple, which suggests analysts expect significant earnings growth ahead. The PEG ratio, which divides the price-to-earnings multiple by expected earnings growth, reads at 0.00. This unusual reading reflects the fact that the company's earnings base is still unprofitable or break-even on a net income basis, making traditional PEG analysis unreliable here. The enterprise value to EBITDA multiple stands at 147.49 times. For reference, a typical industrial software company trades at 20 to 35 times EBITDA. The price-to-sales ratio is 10.43 times, suggesting Axon is valued at roughly $10 of enterprise value for every dollar of annual revenue. This is elevated relative to industrials peers, which typically range from 1.5 to 3 times sales. Our DCF analysis suggests the stock is trading at a 0% margin of safety to intrinsic value. In other words, the current market price reflects our estimate of fair value, with no margin for error or downside protection. Wall Street analysts have a consensus mean price target of $662, derived from 18 covering analysts. That implies upside of approximately 70% from current levels. The high target stands at $825, the low target at $410. Taking both signals together, a reasonable fair value range in our view sits between $550 and $750. The near-term catalyst to monitor is the upcoming earnings release on August 3, 2026, where consensus estimates expect earnings per share of $1.83. Market sentiment around Axon Enterprise leans bullish, with the company demonstrating strong revenue growth momentum, particularly a 34% year-over-year increase in the most recent quarter, and positive analyst commentary highlighting its position as a top industrial growth stock. The setup here is one where the market is pricing in substantial future earnings expansion. If management executes on growth guidance, the valuation is reasonable. If growth decelerates, downside could be sharp. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point financial health checklist that evaluates profitability, leverage, liquidity, and operating efficiency. Axon scores 6.0 out of 9, which lands in the pass range but below ideal. Specifically, the company shows concerns around profitability and return on assets, offset by reasonable liquidity and debt management. The Altman Z score, a bankruptcy risk model that incorporates working capital, retained earnings, earnings power, and leverage, reads at 6.20. This places Axon firmly in the safe zone. Typically, any Z-score above 2.99 is considered low bankruptcy risk. The company's cash-to-debt ratio is 0.91, meaning for every dollar of debt, Axon holds approximately 91 cents of cash. This is a reasonable position, though not exceptional. Interest coverage, the ability to service debt from operating earnings, registers at 0.00. This is a red flag. The metric indicates that operating income does not currently cover interest expense, which means the company is serviced debt from retained cash or other sources rather than from the cash flow generated by operations. Current ratio stands at 2.53, meaning the company has $2.53 in current assets for every dollar of current liabilities due within the year. This is healthy and well above the 1.0 threshold required for basic solvency. Debt-to-equity ratio is 0.59, indicating moderate leverage. For every dollar of shareholder equity, Axon carries 59 cents of debt. This is manageable relative to peers. Though not pristine, the overall picture is one of a company with adequate liquidity and moderate leverage, but where current operating profitability does not yet support the debt load. This is not a solvency crisis, but it is a constraint that limits financial flexibility. If operating margins improve materially, this position strengthens considerably. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, measures how much profit the company generates for every dollar of capital invested in the business. Axon's return on invested capital is negative 1.62%. This is the most concerning profitability metric on the sheet. It means the company is destroying capital rather than creating it. In normal circumstances, management would need to cut costs, raise prices, or redeploy capital more efficiently. However, for high-growth software companies in heavy investment phases, negative return on invested capital is sometimes temporary if the company is spending aggressively to capture market share with the expectation of profitability later. We need to monitor whether this improves as the business scales. Gross margin, the percentage of revenue remaining after direct costs of goods sold, stands at 59.66%. This is healthy and typical for software and hardware businesses that have achieved manufacturing scale. Operating margin, which measures earnings before interest and taxes relative to revenue, is negative 2.23%. This negative reading reflects the fact that operating expenses, including sales, general and administrative costs, and research and development, currently exceed gross profit. For a growth stage software company, this is common, but it signals that the company is still in investment mode rather than harvest mode. Net margin, the percentage of revenue that flows to the bottom line as profit, is 4.49%. This is positive, which means the company is technically profitable on a net basis, but only barely. The company is burning minimal capital, but not generating strong returns either. Free cash flow margin, which represents the percentage of revenue converted to actual cash available to reinvest or return to shareholders, is 2.70%. This is thin. It means Axon generates only 2.7 cents of free cash for every dollar of revenue. For a high-growth software business, this is concerning because it limits the ability to fund growth organically, acquire competitors, or return cash to shareholders. The profitability stack shows a business that is scaling revenue but has not yet achieved operational leverage. Cost structure needs to improve meaningfully. Onto growth. Is this business expanding and at what rate? Revenue growth over the trailing 3 years stands at 32.80% compounded annually. This is exceptional. Over the past 5 years, revenue growth registers at 25.50% compounded annually. The deceleration from 5-year to 3-year rates is modest, from 25 to 33%, which suggests the company is accelerating, not slowing. For context, typical industrial software companies grow in the range of 10 to 15% annually. Axon is more than double that pace. Book value growth over the trailing 3 years stands at 31.60% compounded annually, which closely mirrors revenue growth. This is a positive signal. The company is reinvesting earnings and growing tangible value for shareholders, not just generating accounting profits through financial engineering. In the most recent quarter, revenue grew 34% year-over-year, which actually exceeds the 3-year average, suggesting the company may be accelerating even further. This growth is driven by 2 factors. First, increased adoption of Axon's cloud software suite by existing law enforcement customers. And second, geographic and vertical expansion into fire and emergency services, which historically have been undersized markets for body camera technology. The company has not announced a dividend, and the dividend yield is 0%. This reflects management's decision to reinvest all available capital into growth and research and development rather than returning cash to shareholders. For a high-growth company, this is appropriate. The growth profile is the clear strength of the investment thesis. At current revenue growth rates of 34%, even the elevated valuation multiple makes more sense. However, this growth is not guaranteed to continue indefinitely. Any deceleration below 20% would likely trigger multiple compression, which would hurt returns. Now let's talk smart money. What institutional capital is actually doing with this name? According to Dataroma, which tracks the 13F filings of leading institutional investors, 11 top-tier gurus currently hold Axon Enterprise. This is meaningful. It indicates that the best investment minds in the world see something compelling in the name. Of 13F institutional filers tracked, 6.3% are net buyers, meaning they own more Axon than they did the previous quarter. This is below the 50% threshold that would indicate broad institutional bullishness. However, given that only 11 gurus hold the position at all, and those 11 are net holders, the signal is more selective than universal. Insider ownership stands at 7.80%. This is moderate. It suggests that founders, executives, and board members own a meaningful stake, which aligns their interests with public shareholders, but they have not loaded up on the stock at current prices. Over the past 3 months, insider transactions show 0 buys and 10 sells. This is a red flag. The fact that company insiders are selling, not buying, at current prices suggests skepticism about valuation or confidence that future stock performance will be slower. Insiders typically have the best information about business momentum and typically sell for tax or diversification reasons, but concentrated selling without concurrent buying warrants caution. The smart money picture is mixed. Top-tier gurus are holders, which is positive, but the absence of insider buying and the actual presence of insider selling suggest that not everyone with inside information is confident in the current price. This is a yellow flag, not a red flag, but it merits monitoring. And finally, the verdict. Let's bring it all together. On valuation, the company trades at multiples that are elevated relative to historical norms and peer averages, but not unreasonable if growth accelerates as expected. On financial strength, the balance sheet is adequate, with reasonable liquidity and manageable leverage, though interest coverage is a concern that warrants attention. On profitability, the business is currently unprofitable on an operational basis, with negative return on invested capital, a structural issue that must improve if the thesis is to hold. On growth, the company is expanding revenue at exceptional rates, 34% year-over-year, which is the core pillar supporting the bullish case. On smart money, top institutional investors are holders, but insider selling without corresponding insider buying raises questions about confidence at current prices. In our view, a fair value range for Axon Enterprise sits between $550 and $750, representing upside of approximately 42 to 93% from current levels. The recent quarterly results showed strong revenue momentum, but the fact that the company is still operating at a loss and generating minimal free cash flow is a constraint. The bull case rests on the assumption that as revenue continues to scale, management can extract operating leverage and drive margins positive. The bear case rests on the possibility that the competitive moat proves less defensible than assumed, or that pricing pressure in a saturated market forces multiple compression. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Axon Enterprise. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.